Coming now to the components of pension costs. Under IFRS, we have three components. The first component is service cost, then we have net interest income or net expense, and the third component is remeasurements. Service cost is the amount by which pension cost increases due to an employee's service. So let's say, for example, that for the service that an employee provides during a given year, that employee will get a benefit with an estimated value of 25, and this benefit becomes due at the end of year 10. And this benefit is there because the employee worked during this time. So when we take this 25 and come up with the present value over here, that represents the service cost. The service cost is recognized in the profit and loss statement. The next item is the net interest income or net expense. This is recognized in the profit and loss statement. The calculation is as follows. We take the net pension liability or asset and multiply by the interest rate or the discount rate. The third component is remeasurements. This is the net return on plan assets and actuarial gains and losses. Remeasurements are recognized in other comprehensive income and they stay there. So this amount is not subsequently amortized to profit and loss. So the remeasurements have two parts. One part is the net return on plan assets. This is the actual return minus the plan assets into the interest rate. The second component here is the actuarial gains and losses. This is equal to changes in a company's pension obligation arising from changes in actuarial assumptions. So for example, if there is a change in assumption about the discount rate or a change in assumption about the rate at which salaries will increase, then the impact due to that is shown under actuarial gains and losses. Now let's use some numbers to understand these different components. If we have a company where the present value of the defined benefit obligation at the start of the year is 140 and the fair value of plan assets at the start of the year is 120. Our discount rate or the interest rate that we'll use is 10%. The actual return on assets is 15, service costs 7, and increase in pension obligation due to changes in actuarial assumptions is 4. So the service cost is simple, that's given over here. That is 7. Then the next component is net interest income or net expense. This is the net pension liability, and notice here the net pension liability is 20. So that's 140 minus 20. We have the net pension liability multiplied by the interest rate, which is 10%. So multiplied by 10%, this gives us 2. Then we have the net return on plan assets. This is the actual return, which is 15. That's coming from here, minus the plan assets into the interest rate. The plan assets are 120. Interest rate is 10%. 120 into 10% is 12. So our net return on plan assets is 3. Actuarial gains and losses, this number is given, that is 4. So these are the different components. The total pension cost is the sum of these numbers. So that is 9 and 7, which is 16. Components of pension costs under US GAAP. The first difference between US GAAP and IFRS is that US GAAP draws a distinction between current service costs and past service costs. Current service costs represent the amount by which the pension obligation increases as a result of employees' service in the current period. Past service cost is the amount by which the pension obligation relating to employees' service in prior periods changes as a result of plan amendments or a plan curtailment. Now, current service cost is recognized in P&L, whereas past service costs are recognized in OCI and subsequently amortized to P&L over the service life of the employees. The interest expense on pension obligation is recognized in the profit and loss. So here we take the interest rate and multiply that by the pension obligation. The expected return on plan assets is recognized in the P&L, and the amount is calculated by taking the plan assets and multiplying by an expected return. The final component is actuarial gains and losses, including differences between the actual and expected return on plan assets. This component can be recognized immediately in the profit and loss, or what is more common is for this component to be recognized in OCI and subsequently amortized to profit and loss. We mention the difference between actual return and expected return, so that's shown over here. We come up with the actual return, and from that we subtract plan assets into expected return, so that number is coming from here. The actuarial gains and losses are the changes in a company's pension obligation arising from changes in actuarial assumptions.